Hello, everyone, and welcome to today's session. On behalf of everyone at Rev.io, I'd like to thank you for joining us today. I'm Delaney Dabkowski, Rev.io's Marketing Execution Manager. Before we begin the presentation, I would like to go over a few housekeeping items. First, audio will automatically come in through your speakers. Second, a recorded version of this webinar will be emailed to you within 2 weeks. Third, we will be having a Q&A session at the end of the event. Please submit your questions via the Zoom control panel at any point during the live presentation. For those of you just joining us, welcome. Today, Brian Greer, TaxConnex partner and CRO, and David Rubenstein, CCH SureTax Senior Telecommunications Tax Specialist, will be discussing effective strategies to achieve communications tax and regulation compliance. Without further ado, I'd like to introduce Brian and David. Brian Greer is a partner at TaxConnex based in Atlanta, Georgia. TaxConnex provides sales and transaction tax compliance outsourcing services to companies throughout the country. Prior to joining TaxConnex in 2010, Brian worked at Thomson Reuters and Tax Partners dating back to 2000, where he held various leadership positions in their tax compliance divisions. David is a licensed CPA. He is Walter Kluwer's professional services team's telecommunications tax expert. David has over 20 years experience in the telecommunications tax space. David is in charge of SureTax configurations, where he performs product mappings, overrides, and other services to ensure that you obtain the most accurate results from the SureTax system tailored to your business model. Now I'll turn it over to Brian and David.
Hey, Delaney, thank you for the introduction. This is Brian Greer at TaxConnex. Welcome, everyone. I just wanted to run through the agenda here real quick with you. When David and I first sat down and started to put together the agenda and what we wanted to speak to you guys about, we started off thinking that this would be kind of a Telecom 101 type of discussion. So we originally were going to talk about the different hierarchies of compliance from a state and federal regulatory as well as tax compliance perspective, and address some of the misnomers that maybe new telecom service providers might encounter from time to time. However, as we started to get some questions asked to us even prior to the session today, and in seeing the attendees that were registered, it seemed like most of the people that are attending today have likely been in the telecom space for a number of years and might be a little bit more advanced. So we've tried to structure this as, I don't know if you want to refer to it as a Telecom 201 class or a 301, but we're going to assume that there's a basic level of knowledge here. Certainly, if you do have any questions, as Delaney mentioned, feel free to submit those. So hopefully, like I said, we're going to cover a couple of different primary topics here. David's going to talk to us about some specific unbundling capabilities and reasons why you may or may not want to do that. We're also going to talk about the federal USF in terms of what the new rate is. I think we've reached a new high. And also talk about some strategies as to how we might be able to reduce that in terms of the billing to the customer. And then we're going to wrap up with a little bit about COVID in terms of some of the filing and payment deferral options that we've seen from a state and local tax perspective. And then we're going to wrap up and kind of give you guys an overview as to how does all this fit together in terms of what does Rev.io do? What does SureTax do? What does TaxConnex do? And kind of put it all together so you see how it all fits together to provide an overall compliance solution for you. So David, I'm going to go ahead and turn it over to you then for the first piece here.
Thank you, Brian. So we live in an age of amazingly fast technological change, and the impact in the telecommunications tax regulatory space has been enormous. These products seem to come faster than you can blink, And what was yesterday's newfangled product, which you've just implemented a year later, is now old stuff, and we've now in a new phase of a product. So we're constantly have an evolving faster and faster new products, new pricing, new marketing strategies. And guess what? Tax, surprisingly, is not the driver of all this. Like, it seems actually the business unit seems to push to lead the way, and tax is like kind of like the tail, and with the tail on the dog. And if tax kind of intrudes its way and say, well, what are you guys doing? Say, no, you don't wag the dog, you're the tail. So we kind of get the impact of this new changes that come about, and have to figure it out from there. Well, last year's products were set up. Maybe we did some unbundling. We had some allocations done, which can be very complex to create. We've figured out what codes to associate when our mapping to do one-to-one. Everything's in place, and next your product suite comes about, and everything now has to be reshuffled, refreshed. So this is quite a challenging time that we're living in. Well, what happens in terms of tax? Well, tax rules are, for those well-versed in telecom or not, they're very, by and large, very unclear. When we're doing research projects here at CCH, we find that typically the majority of the rules are actually not able to be have an on-point tax decision per se, like, tax, let's say, on something tangible. That's going to be black and white. Either we do tax, apply sales tax to tissues in New York State, or we don't. But it doesn't go like that in telecom. In general, why the statutes a lot of them are very old, very archaic, very cryptic. Telecommunications tax service is tax subject to tax. So what is that? What is telecommunications tax? Telecommunications service mean? And if the statute doesn't have regs and drill down its code with enough detail, we're left with a big question mark. That was the case before we had all this technology. With technology, it's even the issues compounded. So how do we deal with this? Well, it's very interpretive, and that's one way that's one approach you could take. One approach you could take is we're going to rely on the interpretation. When you're purchasing a database such as SureTax, the rules have been researched by a team. They've been reviewed, they've been tested. That's one route, is just go with the off-the-shelf rules, match up your product on a one-to-one basis as best as possible, and go with that. There may or may not be, however, best practice, because your product might be a little different and not fit in the box. So, and that's, or there may be a gray area, and very likely to be gray area. So even as good as a database can be, there's always the product, whether it matches up and aligns with that database rules, can be an issue. So there's a few different ways you can approach it. You can take risk and go with the flow, go with what the best, the closest match. If you have a jurisdiction where you're concentrating, you could reach out to the Department of Representatives, the DOR. Now, you could either, Department of Revenue, sorry. You could either send a private letter ruling request, which Brian will talk about more later, or you could have informally reach out. Now, if you reach out, the risk is, if your name's on it, you may have an issue, because if you don't get the answer you want, you're going to be stuck with that. Whereas if you have a third party reach out, like we often do that at CCH for clients, that is where you can stay anonymous in the background. However, there is risks in having an informal approach. Even in our early days of research, remember we once called Utah Public Safety Commission, I believe it was, and we had a very detailed list of questions. We went over with the person, and as we'll do when we finish, we'll ask, what's your name and position with the DOR? And he said, well, my name, with the PSC. He says, well, my name is Bubba. They said, oh, great, Bubba, what do you do there? So he said, well, I'm the janitor. So if you call into a DOR, make sure you got the right person. Even then, if it's not a PLR, private letter ruling, the authority can be, of it may be subject to being to debate, and you may wind up holding the bag if you ever have an audit.
So David, I've got a example here to share with you and with the group, and it kind of brings home this point of how interpretive some of this is. So we started working with a customer fairly recently, and they were in the call center space. And being in the call center space, they provided a variety of true telecommunications services in terms of the actual voice service, but also provided software. And that software was delivered in really a software as a service, a SaaS type of format. And in this particular example, in Florida, SaaS is not subject to sales tax. So the business had not been charging sales tax to any of their customers in Florida, specific to the SaaS portion of the product. However, under audit from Florida, Florida kind of wrapped their CST, their communication services tax, around this SaaS offering because the SaaS offering was involved in routing calls to different agents. And as a result, Florida believed that the SaaS should be subject to CST. So if you've been in telecom for a while, CST in Florida can be quite high in terms of what the rate is, can be as much as 12 to 13%. So, this particular business goes from a 0% tax burden on a SaaS offering to a 13% assessment on a CST offering. So, getting this interpretation right is very critical, and seeking out that potential letter ruling, as David referred to, can really help mitigate some risk if it's something that's a little bit unusual and doesn't fit neatly into a box. So David, we'll move on to the next piece here in terms of some unbundling concepts and strategies.
Sure. So given that the new products have created not only different types of products, but a different way of billing than we used to have. I may be dating myself here, but back years ago, you had a phone bill came in the mail, looked like a book. You had pages and pages of usage. Each long distance call was itemized, and you'd have your basic service, a monthly recurring charge, but then pages and pages of which were evaluated. Each minute of usage was evaluated for its tax. In telecom is based on 2 out of 3 rule, whether it's intrastate or interstate. Well, today it's basically all you can eat billing. There is still some usage, but it's not so common and not such a high percent of the revenue that's billed is billed based on usage. Typically, it's more based upon a flat fee. Well, the flat fee has its challenges, and the challenges as we try to manage the tax is that it creates something called contamination, where you'll have taxable along with non-taxable, or taxable and assessable revenue along with non-taxable revenue. And if the bundle is not broken out, or the flat fee, I should say, is not broken out, the bill will typically entirely be taxed. And if you don't go through the effort to unbundle it, you'll have that on both tax and assess for the tax assessments and surcharges as well. So one example of this is triple play. You have 3 component parts of that: your voice, data, and text. As of July 1st, big change in tax law. Internet access is totally exempt, even in the grandfathered states. So that component, which in fact the triple play is typically the most heavily, largest component of the invoice these days, is totally exempt. If you wouldn't be able to unbundle that, you'd be looking at really applying the tax way over the top. Whereas if you unbundle, a good portion of that invoice would be not subject to any tax at all. Now, so there are two ways to unbundle. One is on the face of the bill, and you could actually break out the categories. Now, when the states used to impose not disallowing unbundling, we had that in New York and a few other states, handful of states. So the only way you could unbundle would be if you did it on the face of the invoice. If not, it wasn't allowed. You really don't see that today. It's not, you really don't want to really be disclosing best practices. You don't want to disclose your allocations on the bill, not to the customer, not to the tax authority. That's really something you want to keep in the background. So typically we're going to see back office unbundling as opposed to unbundling on the face of the invoice. Now, in fact, all the states now allow unbundling. So whether it's the federal government, whether it's the FCC, they allow you to unbundle. There's no issue there. The allocations we might want to review on a USAC audit, but you're totally allowed to unbundle for surcharge on the surcharge level, for regulatory surcharges. On the tax size state level, you're allowed to. You may run into some issues on the home rule city because we've run into this recently. A home rule city said, hey, if there's a taxable and a non-taxable item on an invoice where we contaminate, the entire invoice is subject to tax. So like anything else, there's a blessing and then there's a cloud in the horizon. You can run into these audits. They can cost a few thousand, it can cost something, but the best practice is to really go with it, because you're saving so much by unbundling. The risk, mitigation on a local level of having a home rule city doing an audit is probably worth trying to manage that. How you do that in the system is another story. We could, so to speak, talk about that offline. But in summary, dealing with the flat fee billing, your unbundling is definitely the way we see it as the way to go.
Yeah, and David, I found this to be pretty fascinating because I've been in the this industry for a while, and I used to always think about the bundling and unbundling from the perspective that, at least on the tax side, you would have to unbundle on the invoice, else the contamination would require you to charge the tax on the entire line item. So the back office unbundling, I've been familiar with that from a regulatory perspective, but from a tax perspective, that seems like something that's happened really over the last handful of years. Is that kind of a new phenomenon, or is that?
Yeah, there were some stalwart states that were not allowing back office unbundling, which kind of threw a wrench into it, because New York, et cetera, there were large enough states where when you're dealing with a system like a SureTax or any other system, you implement it. It's kind of like you implement it across the board, right? So you're going to have even a handful of states that would not disallow back office unbundling. Really threw, I think what you're getting at, really threw a monkey wrench into it. So it had we had rules in our data to accommodate, to split up through the allocation of the service. So that would be done to deal with that issue. But now they pretty much, over the last few years, these fell away. And it's probably because of the pressure of the change in of the billing, because everything being billed flat fee, by and large. So for state to disallow that would really wreak havoc. So in any event, over the last, yes, correct. In the last couple of years, there's been a change.
Yeah, it certainly makes it a lot easier for businesses to bill it in this fashion. So, all right, let's move on to the next piece here. Some updates and changes in tax law, David.
Sure. So we're actually having much less changes quantitatively for this July 1st than usual at this time of year. Usually July 1st, like really heavy tax law changes. July and January, usually the biggest ones. They're usually fairly equal. This year we have just a handful of really major changes, but they're biggies. So what we lacked in quantity, we've compensated with quality. The first is a grandfather clause. Grandfather clause is subject dear to my heart, being a grandfather, but it's expiring as of July 1st, so that sales tax, which previously was allowed by 8 states to impose tax on internet access under ITFA, they had a clause, but they expiring another week to go, July 1st, and it's out the door. All internet access will now be exempt, which is a good thing. And if you weren't aware of it, well, you'll know what's coming up a week from now. Second change is even more monumental because it's going to impact all of our telco invoices that are subject to FUSF. The FUSF is going up to 26.5% effective July 1. Again, that's 26.5. That is a huge number. Last quarter, for example, was 19.5 and went up 7 percentage points in one quarter. I believe this is the largest jump that I'm aware of in one quarter, and I believe this is a historical high, or certainly close to it. The rate will now mean that if you charge $1 for a service, and it's subject to FUSF, let's say entirely, let's say by a CLEC service. So now your bill is, and it's interstate, automatically, like say a private line, it's going to automatically be $1.26.5 just for starters. So before we even get to sales tax and gross receipts tax and yada, yada, yada. So this is huge. The federal TRS is also being changed. It's effective July 1. There's not only going to be a rate that applies to interstate service, somehow there's going to be a rate on intrastate of 1%. This is brand new. I've never seen anything like this. What's really quite phenomenal about this is that we know there's something called the Interstate Commerce Clause. So this meaning the states tax intrastate and the federal government tax interstate because that's their jurisdiction. Well, somehow they're able to now tax intrastate as well. So not being a lawyer, I'll not take that one on as far as how they're working that. But as far as nuances and details on this, hopefully we've just published a release note on it. And if anyone is interested in that release note, we could send it to you after the call today. So just please let us know. But you should be receiving that with your month-end release. Again, that was just published. We just published a release note on it yesterday. So you'll have all the details on that 1% rate, which is coming out. And obviously it's huge because now you're going to have TRS and everything. So, which kind of leads us to a question, a little bit of a side point, but I think is worth noting. The question and subject to debate in the telecom tax regulatory circles, whether you could recover the relay. Truth in billing rules are that you cannot state that the TRS is being recovered on an invoice. However, as they would say, query, can you recover it if you call it something else, such as a federal cost recovery? You will probably ask 3 different telecom people and you might get 3 different answers. Well, actually, there's only 2, it's yes or no. But our position is that you can recover it. We have discussed this with USAC. We've discussed this with regulatory attorneys in industry. You don't have to do that if you use our database, obviously. You can always override it and turn it off and suppress it, or you could even increase the rate because at the end of the day, it's a quote unquote recovery. If this is something that, if something you're interested in, definitely discuss it with your regulatory attorney and or person who handles your billing, something to consider as you implement this new expanded TRS rate. The West Virginia state wireless fee, well, if you don't live in West Virginia, it may not be too much of interest, or do business there, but it's now going to be broken out into 4 component parts. That'll also be effective July 1.
So David, coming back to the federal USF and that rate moving up to 26.5%, I've got a theory on this, and I'm just going to kind of run it past you and get your thoughts on it. as we look at a lot of these new services and new technologies that are coming out, the ability or what is deemed to be accessible from a federal regulatory perspective seems to be making the base of services that are accessible smaller and smaller, which tends to drive up that rate. First of all, I guess it's a two-part question. Is that a valid way to look at this, and do you expect to see that rate to continue to increase even beyond 26.5%?
Yeah, definitely. The rate is a function of providing universal service across the entire United States. So the budget is there to be meant to be covered, and as less and less service is being subject to the FUSF because of this emerging technology where things are pushing more and more into what's called information service as opposed to telecom service under the rules of the FTC. So your tax base is contracting. So if you have your budget's comprised of your tax base times rate, if your tax base is shrinking by default, the rate has to go up as long as the budget's a constant. So unless that budget's going to be shrunk, the rates continue to go up.
Yep, makes sense. So let's take a look at some options for minimizing that regulatory amount that shows up on your invoices.
Right. So it's pretty hard to hide this, put this one on the mattress, hide the elephant in the room. It is what it is. The FUSF at 26.5%, even if you after managing it, it's still going to be significant. However, there are ways to manage it. The best way that we recommend is a traffic study. Traffic study means that you go to USAC and you say, hey, we ensure that we have safe harbor, but we're going to, using a prescribed format, we reviewed our traffic, our voice traffic for voice over IP for example, it also could be for wireless, but for the past year, and these are the component parts, whether this was how much was interstate, some was interstate, some much was international, etc. These are all it's a kind of boilerplate template for submittal that gets submitted to USAC for approval. We found that the national average on this is typically 22% is kind of what the word is, that's the reality of it. How the government came up to 64.9, we're not auditing them, but the reality is that we found that SureTax, typically our customers are well below that 64.9. So it's worth doing an internal review of this if you haven't already, and seeing whether you can come up better than safe harbor. And if you can, the steps are fairly uncomplicated to work with your regulatory attorney to submit a traffic study and then implement it into database, which is basically done by overriding the defaults of the safe harbor rate and using your traffic study rate. There's a traffic study rate that applies that will be reducing your safe harbor. So for example, right now, let's say it's the rate 26.5, 64.9 is about 2/3. So the default coming out of the system will be 17, 18%. If you come up to be like 22%, you're reducing that by 1/3. So you're going down from, let's say, 18% to maybe 22%, etc. You got maybe 6, 7, 8%. You might wind up at. Certainly a lot better place than the 26.5. So by all means, start with the traffic study. That's not the only way to reduce the safe harbor, to reduce the effective rate of the FUSF. You would want to look at also service-based exemptions, meaning which of my products, and maybe unbundling plays into this, which of my products are not subject to FUSF. So there's a concept of non-accessible features. So something might be, now we know in telco that there's a tax hierarchy and a regulatory hierarchy. So the tax hierarchy is a subject to sales tax and gross receipts tax, and that's more or less more or less cut and dry with a lot of interpretation. But then there's a totally separate regulatory hierarchy. So the tax is regulated by the Department of Revenue, DOR is your tax authority, and on the local level, your city tax department. On a regulatory level, you're dealing with the FCC and a Public Safety Commission on the state level. More of a concern is obviously the FCC. Those are much bigger rates. The state rates are typically minuscule. Your federal FCC stuff, that even if it's subject or not subject, doesn't necessarily carry over to your state. So you could have something non-assessable. In this case, what we try to accomplish is try to get something to be non-assessable for FCC purposes, but will most likely, in many cases, be taxable for state and local, and that's okay. Because what we really want to do is figure out how to get our service removed of the clutches of this 26.5%. And the sales tax we're not really so much playing around with, because that's a sales tax thing, that's a DOR thing. So if it's taxable, it's fine. Whatever we'll pay for sales tax, 6, 7, 8%, it is what it is. But that 26.5%, which is 3 times or more, or 4 times more than the sales tax, that's a bear, that's a tough one. So let's take an example, enhanced services. You may have something like an auto attendant or et cetera, part of your, let's say, a UCAS suite of services. You could have a number of features in the UCAS or a VoIP service offering that would be considered as non-assessable for FCC purposes, but at the same time, many of them may be taxable as telecommunications. That would require not a separate override or anything, just a separate mapping. Typically, a tax system, certainly CCH, we have special codes for that. They get coded up, and voila, you're not having FUSF, but you will have the tax. So you're kind of having the best of both worlds. You're being conservative for tax purposes. On the other hand, where you want to make sure you're not overpaying and then passing it on to your customer, which is going to make you not competitive in the marketplace, because it is a recovery, but it's going to jack up the cost of your service. So a lot of things, a lot of strategizing around FUSF is really the main area right now in terms of the numbers to really look at. Traffic studies is a way to deal with it. Looking at the enhanced services on the FCC level. There's also something called non-interconnected VoIP, which is another approach to take, and other strategies potentially as well. But they're not mutually exclusive. They're really all can be done. So the more you can take a whack at this, the better.
So David, taking a look at the traffic study option, and hopefully I'm not stealing questions from the audience, but if a company went that route to do the traffic study, submit it to USAC, what have you seen in terms of best practices, in terms of how frequently that traffic study needs to be conducted?
Yeah, we're usually seeing an annual refresh of that, and even when it's done on an annual basis, it's not typically much of movement, in terms of like percent, maybe some are usually a fraction of a percent. And since it's just small movement on an annual basis, companies, when we've seen them try to do it on the quarter, it just becomes almost moot. It's just almost irrelevant to do it. And there is a good deal of work involved in implementing an update, because besides the state side, there's an inverse on this. Besides the federal side, there's an inverse on the state side. So you have the inverse rate on like half the state SUSFs. So you're implementing not only traffic study on federal, you're also doing it on the inverse of that. Traffic study impacts the state, right? Because they're intrastate, federal's interstate. So to do it for a fraction of a percent just may not make sense. It's up to the company, but we've typically seen this done on an annual basis.
Okay, that makes sense. So let's, the next piece here, I'll talk to David, but kind of in hindsight, I wish we had implemented some type of survey here, just so we could understand to what extent any individuals took advantage of the various filing and payment deferral options from a state and local tax perspective. But we saw this happening in mid-March, of course. A lot of the states followed suit from a federal income tax filing and payment deferral option and extended those similar filing and payment deferral options to various sales and transactions taxes. We've got a chart you see referenced here that you could access. Unfortunately, a lot of these are either currently expired or getting ready to expire. I think most of the deferral options went through either June or July. So if you did not already take advantage of this, it may be a little bit too late. But if you did take advantage of it, make sure you are getting everything filed and paid in a timely fashion according to those deferral dates. Something that we have seen, David, over the last, I'd say maybe the last 3 to 4 weeks, we've started to see states come out with shortages from a budget perspective. So when you start to look at some of the impacts of COVID-19, certainly there are numerous impacts, but when you look at it from a state budget perspective, you can see we've seen reports anywhere from 13% declines to over a 30% decline in collections on a year-over-year basis for specific months. So it's something to pay attention to, something that I would expect to likely continue through the third quarter. Hopefully, once we reach the fourth quarter, things have reached some form of normalcy in the sales tax or the transactions tax collections get back to normal, but we're going to be in this budget deficit, budget gap situation. And what does that mean? What's going to happen? What are we expecting to see happen over the next 12 to 18 months as a result of that? Well, similar to what David was describing with the federal USF in terms of the shrinking tax base leading to the increased tax rate, those are really the two levers that a state has to pull in terms of are they able to sweep up certain services that maybe were not subject to tax before, so expand that tax base. I would expect to see an expansion of the tax base. I'm sure we'll see some increase, some upward pressure on the tax rate, but politicians seem to like to adjust the tax base more than they like to adjust the tax rate. It's a little bit more hidden from the public view, so I would expect to see that expansion of the tax base. And then the second thing that we're expecting to see is increased enforcement. Said differently, additional audits. So we all know how much fun that is, but I certainly would expect to see increased audits over the next 12 to 18 months. Anything the states can do to close this deficit, I think you're going to see. So we're getting close to wrapping up here for you guys, and hopefully we've got some questions that have come in up to this point. But just wanted to have some general dialogue around specific tax compliance strategies. A lot of what David has described is, I would kind of categorize it as formulating the tax policy within the business and what's our overall strategy going to be. And these thoughts that I've got outlined here really start to play more in terms of now we're getting ready to start billing our customers, and now we're in a regular compliance mode where we're collecting and remitting. But one of the first things that I like to do and make sure that we have set up correctly when we start working with a business is this mapping review. And David had mentioned it before, but just to this will be somewhat of the Telecom 101 that I referenced before. What we're talking about, if you're not familiar with it from a mapping perspective, is that you all have a set of products and services that you're selling, that you are invoicing to your customer. On the flip side, SureTax has a very comprehensive catalog of various products and services, primarily services here as we're talking about telecommunications services. But it's a very comprehensive catalog where they understand the various taxing rules, regulatory rules, rates that apply to that specific category of service. So the mapping that I'm talking about is mapping your product or service into the SureTax catalog so that the tax and the regulatory fees get applied appropriately. That's a critical aspect of this. Certainly, once that mapping is done, we want to make sure we're doing some type of review of sample invoices just so we get the answer that we expect to get, and we've configured everything appropriately from a technology perspective. To come back to one of the first points that we talked about, a lot of times this is very interpretational in terms of what bucket or what category a specific service fits into, and that's where we may get into a more specific taxability review to determine, what is it that we're selling here and what taxes should apply. And sometimes, as we mentioned, you get into a spot where there's just not a nice, neat box. There's not a nice, neat interpretation as to what it is. And then we might have to go the route of that private letter ruling to get the specific definition and the specific application of the law to that service that we're providing. So it's very important to get this set up correctly up front to make sure that we are charging and collecting the appropriate taxes and regulatory fees. From an ongoing perspective, what tends to happen from a telecom perspective, and what's unique, there's a lot of unique factors in telecom, but one of the unique factors is that, at least from a state and local tax perspective, there's a little bit less scrutiny and less emphasis placed on determining nexus. From a sales tax perspective, we're always looking at, do we have a physical presence? And now we've got the economic presence in a post-Wayfair scenario. In the telecom world, what's the generally accepted principle has been, wherever you have a customer, you have nexus, and therefore are required to collect the applicable taxes and fees. And that could be viewed as a conservative position. As I said, it's a somewhat accepted position. And the reason being, what the states have argued is that in providing and delivering your communications service, whether you own it or not, you're taking advantage of infrastructure in a specific state. So you couldn't deliver the service without accessing some type of tower or fiber or switches or whatever the transport mechanism is that gets the information, that gets the service to the customer. The states attribute nexus to you as a result of that. So what happens, that's a long explanation to get to this threshold comment. What happens is you start collecting all of these taxes and passing through these various fees everywhere you have a customer. And invariably what happens is you pick up a customer in a rural Texas area or a small city in California, and now you've got a right-of-way fee or a utility users tax fee that could be pennies or a couple of dollars, and you've collected it, so therefore you should remit it, right? That's the very conservative position and what you should be doing. However, there's an element of business knowledge, and I like to describe it as, there's a risk-reward here. So yes, you should be collecting and remitting that dollar of tax, but it's going to cost you a lot more than $1 to remit that. So we usually like to work through a threshold with clients to identify what that risk tolerance is. And it's going to be different for every business. It could be 0, meaning register, file every penny. Other businesses I've worked with say, I'm not doing anything until I've got $1,000 of accrued liability in a jurisdiction. That's okay as long as you recognize, and as long as that business recognizes the risk of collecting but not remitting that money right away. The last piece here is just to periodically look at the filing frequencies on some of your returns. If you're into this already and you're filing in a lot of jurisdictions, you're going to see in some situations, maybe you have triggered that threshold, so you've started to register, you started to file, but now you do have a few dollars a month of tax that you're paying in. You're now registered, you've got to pay it in, you got to file that monthly return in that local jurisdiction. You can potentially petition those even local jurisdictions and get a reduced filing frequency. As little as you want to submit a $1 or $2 or $3 check, they don't necessarily want to get a $1 or $2 or $3 check from you either. So they might be very willing to work with you to get a quarterly or an annual filing frequency on returns where you've got a very minimal tax obligation to report. So, David, the last piece of this, before we turn it over or open it up to some questions, and I think we've left a little bit of time here, I thought it would be helpful just to kind of put this all together in terms of how do these three different businesses, we heard from Delaney at the beginning, what do we all do? Maybe it's obvious, maybe it's not, but if we start with Rev.io at the center of this, specific to what we've been talking about, from a billing perspective, we're going to generate invoices to the customer out of Rev.io. Certainly that's not the only thing that Rev.io is involved in, but specific to this discussion, the invoices are going to come from their system. And what happens in terms of this calculation of taxes and fees is that Rev.io is going to send a data packet to SureTax. And that data packet, among other things, will contain some type of service code. This comes back to that mapping that I talked about to make sure we've got the right mapping. But they're going to send a service code that's going to apply to something, a category within the SureTax database. So that service code, along with some type of geographic indicator, so that we know where the transaction is sited, and then some revenue or the charge amount. And based upon those criteria, those factors, then SureTax will calculate the applicable taxes and fees on that transaction and send those back to Rev.io for presentment on the invoice. And then throughout the month, SureTax is collecting these, I shouldn't say collecting, but let's say storing these calculations in their database so that at the end of the month, that tax data can be sent to TaxConnex for filing and remittance. So that's kind of how it all fits together. Hopefully that makes sense. So Delaney, I think David and I are finished, and we'll flip it back over to you if there are questions from the audience.
Great, Brian and David, thank you guys so much for your time. Before we begin the Q&A portion of the presentation, I'd like to thank our audience for joining us today and review a few housekeeping items. The first reminder is that we're always interested in topics that you'd like to learn more about, so please submit your topic ideas in the Q&A box. In addition, the full webinar recording will be emailed to you within 2 weeks. Lastly, if you've submitted any questions during the presentation that don't get addressed in the live Q&A, we will be following up with you individually via email. Now I'd like to ask a few questions from our audience. What are the best practices around handling customer exemptions?
So that's a great question. So customer exemptions can be a very tricky area for a telco to handle. And the reason is that, first of all, there's many different types of customer exemptions. There's as many as 20 principal categories and some offshoots as well. Now, any individual category, to handle it without a system would be extremely difficult, and that's because the number of tax types within a given that are assessed on an invoice, if you look at your high tax district like in New York or LA or Florida, you're going to have many taxes showing up in an invoice. You could have 10 or 12 line items, or Texas also. And given there's just so many different taxes, just because something is exempt on one particular line item doesn't mean exempt from another. For example, federal government will be exempt from sales tax if you sell to the government. A lot of us do, but they're not exempt from FUSF. Even though they are the federal government, they're not exempt from FUSF. So if you apply in all or nothing, and there's a customer is either all taxable or exempt, and there's, once he gives you a exempt certificate, if you apply that across the board, even though it only says sales tax on it, you're most likely going to have a gap when it comes to a, if there's ever an audit, God forbid, and you'll find out that you exempted customers where you shouldn't have. So it's not at all all or nothing, black and white. There's shade. There are some taxes, fees, surcharges are exempt. Some are still subject to tax. That's the typical. We happen to handle that in our system with a module. It's called the customer exemption smart chart. Either it's available as smart chart or as a module, but that has all state level taxes and the 20 principal categories like I mentioned before, and it gets very granular. It's a very difficult area to handle on your own. So, good question.
Thank you. What part or parts of our bundle specifically is subject to FUSF?
Well, we only have a couple of minutes left, so we're not going to give the full answer to that one. We'd probably need to have another session just dedicated to that. So the bundle, depends on the bundle, how many parts were there that it was split out to? What are the component parts? Let's say you had just for a give illustration purpose, let's say you had a VoIP bundle and you had a line charge, you have all you can need, so you're giving LD, your usage included, and then you have features, and you have different types of features, call forwarding, call waiting, then you have auto attendant, and you have ring, whatever, all the different newfangled features that we have in for VoIP and UCaaS and whatnot. Maybe there's voicemail support. Maybe there's some tangible personal property thrown in. You're giving them a phone for the period of the contract. So each of these are different, right? So tangible personal property will not be subject to FUSF. Features that are accessible, which would be like call forwarding, call waiting, those will be subject to FUSF. Features which are considered information service for FUSF purposes, like the auto attendant and whatnot, will be enhanced services, not subject to FUSF, but yes, subject to tax. Support, if that's part of your bundle, will be exempt from FUSF because that's not quote-unquote telecommunication service. So each item in the bundle will need to be analyzed. Now, if you're using a system, you're simply going to break out your bundle into pieces, and then you're going to map each item. In other words, you're not going to map on the bundle level to a tax code. You're going to map on a detail level on each item of the bundle that's broken out separately will be mapped to a tax category, and then the FUSF applicability will be determined on the item level, not on the bundle level. I hope that answered the question.
Hey, David, I'll just add to that a little bit as well. When you are looking at the unbundling aspect of this, you do have to apply some reasonable business logic to this, and what I mean by that is you can't take a handset, a phone like you referenced, bundled with a VoIP service for $20 and say, oh, well, $19.50 of that is associated with the phone and 50 cents of that is associated with the VoIP service, and therefore only 50 cents of that $20 is subject to USF. So there's got to be, books and records that support the allocation as well. Again, thinking about it from an audit perspective, you got to be able to defend that appropriately.
Oh yeah, your allocations need to be able to be supported by something other than air and vaporware. So your costs may be part of that out of the allocation, how much is each element of the bundle, what does it cost to you? The ideal way is if you have an a la carte price for it, of course. That would be, that would be the ideal where, if you're breaking your bundle into 6 parts, let's say, and each has an a la carte price. So then what happens is why is it bundled then? Because you're giving a discount on a package. So let's say each element sold for $3, but your bundle sells now for $15. So you have let's say 20% discount. Then each item market price, so individual a la carte, gets shrunk down. The only issue there is the catch. FCC doesn't allow the accessible portion to be shrunk. So when you're doing that, so if you have, let's say 2 of the 6 elements of the bundle are accessible, but then you're being discounted because they're part of a package, you need to use the retail a la carte price for the accessible portion. The other elements can be shrunk down and discounted. So there's always a catch, right?
Thank you. How often would tax codes change?
Brian, I'll give that one to you since you're doing the compliance.
Yeah, I'm trying to read into what the real question is in terms of the tax codes. Certainly in terms of, I interpret that as 2 ways. There's rates and rules. I would expect from a rules perspective in terms of whether something is subject to tax or not. Was the question, how often do those change?
Yes.
It's hard to say, and I know that's not a great answer, but there tend to be specific times of the year when rates and rules do change. We tend to see more at the very beginning of the year and then mid-year. I would definitely expect to see, as we were talking about, from a increased expansion of the tax base, I would expect to see some new rules put into place for the beginning of the year. So as we work through the next 6 months, I wouldn't be surprised at all if we see additional services that become subject to tax that aren't currently subject to tax. Not sure if that answered the question at all, but anyone that wants to reach out individually and have a more specific conversation, I'd be happy to do that.
And for the last question today, can a carrier contact SureTax directly with mapping questions? If yes, who is a good contact for that?
Sure, you definitely can, and we encourage you to contact SureTax with mapping questions. Your contact is our sales team, Shauna and Evan. So if you'd like to follow up with us on that, we'll be able to put you in touch with them to be able to assist. And I would ultimately be assisting you with that, but best way to reach us is through sales.
Great. Well, thank you everybody for joining. Enjoy the rest of your day.
Thank you, everyone.